I'm staying cautious because there's lots of reasons to be cautious. Until this morning, the market seemed to be ignoring those reasons and has had a nice significant rally on a year-to-date and a big move off the October lows. The market is worried and refocused on the debt ceiling crisis, as Yellen mentioned yesterday that the U.S. may run out of cash by June 1st and need to start some extraordinary measures, meaning they're not going to be able to pay all of their bills unless the debt ceiling is raised. The debt ceiling saga that's taking place in Washington, D.C. right now is merely a symptom. It brings focus to the fact that the debt is out of control in the United States. Since the great financial crisis in 2008, and then bumped up by the COVID spending and shutdown of the economy and the massive stimulus that they were putting in place with checks going out and employment guarantee checks going out to businesses, the debt has just spiraled out of control and is approaching $32 trillion, which you can see on the chart behind me. The debt, was basically manageable until the financial crisis, and there was a way to fix it through reduced spending and a little constraints by the federal government on its spending habits. But now it is completely spun out of control, and the interest on the debt is going to cause the debt to compound dramatically. And in addition to that, we're still running somewhere in the neighborhood of $1.5 to $2 trillion deficits that are adding to the debt. So there's really no way that the debt is ever going to be repaid. And this doesn't even take into account that Medicare has a unfunded $35 trillion liability, and Social Security has an approximately $22 trillion liability. So we got $32 trillion in debt, we got a $35 trillion at Medicare, $22 trillion at Social Security. Those are really big numbers compared to the U.S. economy in total, which is around $22 trillion. And then the federal government is taking out taxes of something in the $4.5 trillion a year neighborhood, depending on the tax year. So you can see that the numbers just don't add up. There's no way the federal government's ever going to be able to pay this back. And we are looking at some sort of crisis with regard to the debt levels at some time here in the future, and it may actually be upon us. So this is the big item to keep a watch on, but there's definitely some other items that is going to cause angst for stock market investors. Over the weekend, First Republic was seized by the FDIC. It was then sold off to JP Morgan with guarantees by the FDIC that Morgan would not end up losing too much money on some of the assets that they were buying at First Republic. So it was a very good deal for JP Morgan. They picked up some nice revenue streams, and then they got a guarantee that the losses will be de minimis. The other item is that the Fed is going to be meeting and releasing its meeting notes tomorrow. It's expected that they will raise interest rates by another quarter of a point to 5.25. Some people are hoping this will be the final raise. It is very possible that's the case, but not a guarantee, given that the 12-month CPI rate still ran at 5% year over year. It has decelerated dramatically, but 5% is still way above what the Fed has indicated they want, which is 2%. At some point, the Fed is probably going to give in and say 2% is not sustainable. We're going to be shooting for 3%. But when that occurs, you definitely change inflation expectations over the longer term, and it actually makes it harder to get inflation down. So they're very reluctant to do that, but at some point it's very likely that they will have to cave on that item. The other item is QT is back after a pause around the Silicon Valley Bank crisis, failure, FDIC takeover that created a run on some of the regional banks. The Fed did pause QT and actually implemented some special lending programs to reliquefy some of these banks. But QT was implemented last week, and we expect that when we get the March 31 data this week, that we're going to see further QT there. So QT is back. QT is draining liquidity out of the financial system. That makes it harder for people to own stocks and bonds as there's less cash floating around. So we do think that is a negative for the stock market. Earnings for the second quarter are going to be very bad. They're going to be in the middle of this credit crunch. The regional banks are seeing a issue with declining deposits. Less deposits mean they can make less loans, and the regional banks are very big, the biggest lenders in commercial real estate. They also are big lenders for mortgages and also for the commercial industrial space. So these are going to be creating a credit crunch across the economy, and if companies cannot get credit, they will not be able to proceed with their expansion plans. They're going to have inventory problems. So this is a big negative, and we're definitely in the middle of a credit crunch that just started excuse me, in March. So keep an eye on that, but I would expect there to be a further economic weakening due to this credit crunch. And to top that off, first quarter year-over-year earnings are coming in above expectations, but still down sharply on a year-over-year basis. So that is a negative that's going to be compounded negative in the second quarter, especially due to this credit crunch. So staying cautious. Please take a look at our website, buildingbenjamins.com, where you can see a full disclaimer, and also sign up for text and email alerts so you'll get this information on a timely basis. I hope you find it helpful, and have a great day. Thank you.